Okay, so now what we're going to do, let's see, one more click. Yes. So now we're going to get to the progressive walk forward, and the idea is that at some particular time we're going to say this is now, and click one more time, please. Yes, and at now, we're going to retune this strategy. So we're going to look back in time, only use that data, and then for the next little tiny period of time, we're going to use whatever we learned from there going forward. So there's no cheating, as some would call it. That period in the new system, by the way, it doesn't say anywhere what it is, but it's 125 days, which is just a few days short of a half a year. But it'll only do retuning when the strategy is going to make a trade anyway. Either when it's going to make a trade or if it's going to stay the same. Tuning will not cause a trade, is the point I'm making. Okay, so that's the notion of it. In fact, this strategy already has these little marks down here. But let's go ahead, click, come back to that. So now we're going to say we want the forward walk progressive tuning, and we want to start on January 4th, 2003. So let's look at that. Yes, click. Okay, so on here we see, here's our January 3rd, 2003. Apparently January 4th is not a market date. They fixed that up. And over here you see these little yellow dots. And those little yellow dots, when you're in the progressive walk forward mode, show you the days in which there was a retuning. And so you see them scattered across starting at that date. And what you see on here nicely is, in fact, well, there's a little tiny haircut that it got, but basically it's all still there. Still getting your 30-ish%. It actually was able to stay tuned all the way across from there. Next slide, please. Okay, decision shift days. This gives you the ability to say, okay, Juds says there's this little hump at the end of the month. Well, what if we want to take it to the middle of the month? Either way, well, you can move this number plus or minus 11 days, and it's plus or minus 11 market days. And there's typically 21 market days in a month, so it's plus or minus a half a month. And in this case, I put -5 on here, and give us a click there, Maestro. And so you'll see that it really had a kind of a profound effect on knocking some performance off there. And you also see over here that the last signal is now the 23rd of April, not the 28th. So, and if you look at the trade signal history, you know, the big long history of when everything happens, you'll see all the dates are shifted. So you can shift that date around and play with it. So not only can you see if it's immune to it, or if maybe the peak really is 2 days this way or 2 days that way, but there's another really important thing. And you might have seen one of this guy's handle on one of the on some of the Hall of Fame things. He's a Florida surfer, FL surfer, and he was asking me about dithering, and he's really technically minded, and got into a lot of questions after we did the last change, because the last change shifted things by 1 day. Most of the strategies really didn't care too much, but some of them went, and you know, what's up with that? Well, it turns out there's if you have a lot of funds that have a lot of common mode market noise, and you move things a day or two, well, most of their gyrations are in common, and everything's okay. But if you have commodities, individual stocks, they're going different ways at different times, and stocks can have, big whippy jumps. And moving something one day this way or that way, now you're into the luck of the draw. And what you'll find when you shift this thing, a day this way, that way, 2 to 3 days each way, go and plot it. And I know some of you, Al will do this. He plots everything. You take a strategy and plot it, what are the returns you get plotted across those 11 days, and someday I'll have to do something with this, an automatic characterization of the stability of a strategy or something. The smoother that line is, the more stable it is. And the more erratic it is, the more it's going to be luck that you're going to do well, or luck that you're not going to do well, because it's erratic. Okay, so that's a tool for you to look and evaluate how stable is this thing, or am I just on a lucky peak? And I'll show you a lucky peak coming up. So now we have these last two things here. Stronger filtering. It's occasionally helpful when the handoff from one fund to the next is a little chaotic. Handoff. Well, this is about the common mode noise again. And the analogy I like to use is a handoff of some runners in a relay race. And I was a wimp on a track team in high school, but I saw the mechanics of what went on. These guys running along, and the next guy starts running at the right time, and their hands have to be going together in order for the one guy to get the other one. And when they didn't do it, the baton got dropped, and of course those guys lost. And making the good handoff is an important thing. And the more chaotic things get, the more you have to pound the heck out of the noise to pound it down. Now, most of the time, I'd probably say for 90–95% of strategies that isn't going to help you. But the way that the optimization algorithm works for standard SectorSurfer, there's a zone in which it will automatically bump that up. And so some of them do use that. But in the new optimization thing, it's just the most common type filter. If you want to get a third order filter on it to see what it's going to do, you can check it and uncheck it and see if it helps.
How do you know that you have chaotic data or noise, and that you might want to use by looking at some kind of trend here?
Well, you can tell by looking at their charts. Like if you say their stocks, yeah, okay, they've got lines of their own. If they're a bunch of sector ETFs or sector funds, they're probably pretty good. But a lot of the narrow sector ETFs are making these things way narrow. And in fact, the point to be made, I was at some time a year and a half ago working with an economics professor who kept saying, "This is full of crap." And I was trying to work with him and get him on board. And one time he gave me some blind data that he generated from something or other back in the 60s and the 70s. And I didn't know what was in it. But in hindsight, when he showed me what the data was, one of the sectors was candy. That's a sub-sector of food. That's going to be way chaotic, like some of the really narrow oil field things. So when you get into the narrower the things are, the more likely you are going to be to having some chaotic things. Next one, please.
Are you switching subjects now? because I'm probably the only one in the room that's somewhat lost on your walk forward. And are you going to talk about that anymore? Or?
Yes.
Okay.
Okay, the bias question first.
Well, maybe you're gonna talk about this, but the stronger filtering, would you do more precisely? Just a more high order filter, or what is it?
Yeah, the standard filter is a second order filter, and it just turns it into a third order filter.
Okay. So better rejection.
Yes.
So Scott, is that in response to the behavior of stocks as opposed to sectors? Or what was the motivation there?
That was kind of the motivation there. Interesting thing, when, I just want to focus on your word stocks. As I chastise stocks kind of a little bit as being chaotic, but General Electric is pretty much the S&P 500, and it's a stock. And Intel is pretty broad. Intel's like a whole sector unto itself. But then you've got some First Solar and some other things that are really pretty narrow and chaotic, blowing in the wind. So there's a lot of difference from stock to stock. But they're if you think of those chaotic stocks, well-behaved stocks, mutual funds and ETFs, bonds, and money markets, very broad range of character. And to expect one size and characteristic of a filter to handle all of those things the same, you'd expect wouldn't be realistic. So SectorSurfer does its best to find what makes whatever group of stuff you throw at it behave. Here's a